Imagine watching, a quarter of a legendary company's market value just evaporate in a single afternoon. I mean, that is exactly what happened to IBM on July 14th.
That is a historic decapitation. We haven't seen a single day drop like that for them since probably 1968.
Welcome to the show. Looking at the financial landscape today, Wednesday, July 15, 2026, you won't find a single unifying narrative explaining the global economy. We are seeing distinct, conflicting pressures moving in entirely different directions.
You have a massive reallocation of technology capital happening at the exact same time that, well, public infrastructure systems are just buckling under the weight of private debt.
Looking at IBM specifically, they reported a second quarter sales miss of $17.2 billion in revenue, which fell short of the $17.9 billion expected. The stock plummeted 25% to roughly $217.
CEO Arvind Krishna offered a highly specific explanation for that miss. He claimed enterprise customers are actively hoarding cash and shifting budgets away from IBM's traditional software and consulting services.
The narrative he is spinning is that companies are stockpiling capital to buy AI hardware and servers ahead of anticipated supply shortages and price hikes.
Following the money trail actually provides concrete validation for his claim. Capital fleeing legacy tech is violently surging into firms facilitating the artificial intelligence build-out.
Is this AI capital hoarding a verified macroeconomic trend, or just a highly convenient scapegoat for a legacy company trying to mask a structurally bad quarter?
Morgan Stanley just reported a record $21.35 billion second quarter. That was driven by a 69% surge in equities, trading as institutional investors frantically, rebalance portfolios around AI.
RSML, the manufacturer of those extreme ultraviolet lithography machines necessary for advanced chip making, just raised their full-year sales forecast to roughly $49 billion based on insatiable chip demand.
Even amidst intense U.S.-China tech friction, shares in Alibaba and Baidu jumped after confirming their AI models like Qwen are being integrated into Apple devices in the Chinese market.
The capital is demonstrably relocating. The panic surrounding IBM's specific drop created a fascinating incentive structure in the options market.
Because the sell-off was so violent, IBM's one-month implied volatility hit the 99.6th percentile. Options premiums are massively inflated by pure market fear.
Selling the August 21, 2026 190245 short strangle allows a trader to collect an $11.25 premium per contract.
For anyone who doesn't trade options every day, buying into the short strangle is basically like standing in the middle of a recently bombed crater and betting that a second bomb won't hit the exact same spot.
You're selling insurance to panicked investors who think the sky's still falling.
The seller establishes a downside break-even of $178.75 and an upside break-even of $256.25.
The seller profits as long as IBM's stock price stops swinging wildly, consolidates, and remains quietly within those boundaries over the next 38 days.
It monetizes the probability that the initial 25% structural re-rating exhausted the majority of the downward momentum. A rapid recovery is equally unlikely given those frozen enterprise budgets Krishna highlighted.
IBM is showing us what happens when a company has to upgrade its infrastructure but doesn't want to spend the money. That dynamic becomes much more severe when the infrastructure isn't corporate software, but the actual water supply for millions of people.
Incoming UK Prime Minister Andy Burnham moves into number 10 on Monday, and he faces a brutal test regarding failing private utilities.
The immediate signaling mechanism the bond markets are monitoring is his choice for Chancellor of the Exchequer.
Appointing a figure perceived as ideological, such as Ed Miliband, rather than someone viewed as a moderate like Shabana Mahmood or Jim O'Neill, instantly alters the risk premium on UK government debt.
Bond investors require mathematical assurance that the new administration will respect fiscal rules, especially considering the enormous capital required if the government pursues its ambition of bringing key utilities under public control.
Thames Water is the most urgent financial crisis on his desk. The utility is currently sitting on £18.5 billion in net debt, which is roughly $24.8 billion.
They explicitly warned they only have enough cash to operate until the end of 2026. Despite a horrifying operational record where customer complaints jumped 77% to over 120,000, executives somehow walked away with £4.1 million in bonuses.
Paying executives millions while the physical pipes literally crumble is it's like tipping a waiter extra for spilling hot soup in your lap.
The incentives are entirely divorced from operational performance because of the debt structure.
Thames Water requires billions in immediate infrastructure upgrades after years of chronic underinvestment. Current consumer bills cannot fund those upgrades while simultaneously servicing that massive debt load.
Environment Secretary Emma Reynolds already rejected a lender rescue plan that demanded leniency on environmental fines in exchange for capital.
The private market is effectively demanding the government lower its environmental standards just to keep the company solvent.
Which introduces the threat of special administration, effectively a temporary nationalization. Doesn't the taxpayer just end up absorbing the toxic debt in that scenario, while private equity buyers wait patiently on the sidelines to scoop up the newly cleaned assets a few years later?
The government has already officially nationalized British Steel to protect virgin steelmaking from its Chinese owner, the Jingi Group. That operation is costing the public £1.3 million every single day.
The legal architecture of special administration prioritizes maintaining the vital public service over protecting shareholders or creditors. While the taxpayer initially fronts the capital to keep the water flowing, the existing equity is typically wiped out.
Creditors face massive haircuts on the debt they hold. Permanent nationalization transfers the entire multi-billion-pound infrastructure upgrade bill permanently onto the public ledger.
Regional taxpayers outside of London will heavily object to subsidizing the capital's water system through national taxation.
Macro-level public debt eventually trickles down to individual household ledgers. The structural rules altering the consumer's wallet are actually shifting today, July 15, 2026.
Before we look at how regulatory algorithms are changing your checkout screen, a quick reminder that you can find financial candy, brain candy, and classic audiobooks at clarinarratio.com. Looking at the consumer side, the UK government is rolling out new affordability checks for buy now, pay later services, such as Klarna and ClearPay, starting today.
The underlying mechanism of the buy now, pay later industry previously relied on frictionless spending. Platforms prioritize speed at the digital checkout to maximize consumer conversion rates.
Mandating comprehensive affordability checks forces these platforms to introduce friction as a deliberate feature rather than a bug. The government is intervening in the user experience to break the automated impulse buying loop.
The timing highlights a severe consumer strain. The charity Money Wellness reported a record 4,520 customers seeking help specifically with buy now, pay later debt in June.
The market dynamic shifts from guaranteed instant approval to a landscape of higher rejection rates. By adding this required friction and rejecting cash-strapped consumers, do we risk pushing vulnerable people away from zero-interest platforms and directly into the hands of unregulated, high-interest, predatory lenders?
Regulatory interventions frequently generate displacement effects. When legal, structured credit avenues constrict, the underlying financial need does not disappear. It simply migrates to shadow markets.
The regulatory perspective argues that interrupting the frictionless accumulation of microdebts prevents a snowball effect that ultimately destabilizes primary household finances, such as rent and utility payments.
A similar structural trap is currently reshaping the U.S. consumer wallet regarding student loans.
Following the July 4 changes under the One Big Beautiful Bill Act, the mechanics of the Public Service Loan Forgiveness Program have been severely altered, transforming a federal benefit into a bureaucratic maze.
The new legislation leverages default enrollment as a gatekeeping mechanism. Borrowers taking out new loans are automatically placed into the tiered standard plan.
Payments made under this default plan earn 0 credit toward the 120 payments required for public service loan forgiveness.
To qualify, a borrower must realize they are in the wrong plan, actively navigate the system, and opt into the repayment assistance plan, an income-driven model where monthly bills range from 1 to 10% of earnings.
Parent PLUS borrowers are now entirely locked out of income-driven repayment options, permanently eliminating their pathway to forgiveness. Paying those debts requires earning a wage, and new UK laws are rewriting anti-discrimination legislation to require explicit salary information on job advertisements.
The Cabinet Office noted this transparency is designed to weed out candidates with misaligned pay expectations and prevent the opaque salary negotiations that historically disadvantage women and minority applicants.
Information asymmetry acts as a primary driver of wage suppression. When the employer holds the exclusive knowledge of the budget range, the applicant is forced to negotiate against a phantom ceiling.
Mandating a published benchmark rate forces the market to price the role based on the internal corporate valuation of the labor, rather than exploiting the applicant's previous salary history or lack of negotiating leverage.
The concept of structural friction altering market prices brings us to the turbulence raising costs across global physical systems, starting with aviation. United Airlines posted a strong second quarter beat with $1.99 in adjusted earnings per share.
Jet fuel prices spiked 34% in July alone due to the volatility surrounding the U.S.-Iran conflict. That single geopolitical factor is projected to add $6 billion to United's expected 2026 expenses.
The airline industry operates on razor-thin margins, where fuel serves as the second largest operational cost after labor. United is attempting to absorb this shock by hedging up to 90% of those higher costs in the current quarter and passing the remainder on to consumers through higher fares.
Delta Airlines is executing the exact same pricing strategy. The individual consumer bears the ultimate financial burden of distant geopolitical instability through the price of their economy ticket.
When those flights inevitably face delays or cancellations due to global instability, the passenger rights for UK and EU flights carry a very specific legal caveat.
Airlines are legally required to provide refunds, food, and overnight accommodation for significant delays, but geopolitical conflict is officially classified as an extraordinary circumstance.
That classification means zero extra cash compensation for the disrupted consumer. The legal framework draws a hard line between operational failures within the airline's control, such as a predictable staffing shortage and exogenous shocks.
Forcing airlines to distribute cash compensation to passengers for war-related airspace closures would effectively bankrupt the global aviation sector during major international conflicts.
Geopolitical friction also dictates the cost of money itself. The Bank of Korea just hiked its benchmark policy rate to 2.75% to fight 3.2% inflation and defend the won, which had severely depreciated against the dollar.
In the U.S., severe structural friction is being generated from internal security breaches. Former Federal Reserve Advisor John Harold Rogers was just sentenced to over 3 years in federal prison for secretly funneling restricted monetary policy information to Chinese intelligence operatives.
The scale of the economic espionage risk created by this leak is staggering. Rogers had advance access to Federal Open Market Committee deliberations.
Providing Beijing with advanced knowledge of U.S. interest rate decisions could have allowed them to generate enormous risk-free profits by front-running trades on their estimated $1.5 trillion portfolio of U.S. treasuries.
Rogers allegedly executed this espionage by, printing documents, stripping classification markings, and emailing sensitive data to a personal account in exchange for university professorships in China.
Does an economist successfully executing this incredibly basic method of data exfiltration indicate that the world's most powerful central banks have massive glaring blind spots in their internal digital security protocols?
The reliance on academic prestige and implicit trust within insular macroeconomic circles clearly created an exploitable vulnerability.
The central bank security apparatus focused heavily on external cyber threats, such as state-sponsored hacking groups, while completely failing to implement basic data loss prevention software that monitors internal actors moving unencrypted classified documents to personal commercial email servers.
Contrasting that kind of institutional security failure against a company quietly executing its strategy provides a stark lesson in market rewards. Johnson & Johnson just reported second quarter revenue of $25.31 billion.
The stock barely moved on the announcement. Boring, predictable companies like J&J become safe harbor assets when tech capital is violently rotating, providing a masterclass in portfolio defense.
The underlying medical market dynamics for Johnson & Johnson reveal a highly effective strategic pivot. They experienced a slight miss in their cardiovascular medtech unit regarding heart pumps, but their broader pharmaceutical strategy is accelerating rapidly.
Their immunology drug Tremfya is up 72%. The newly launched Icotide, a once-daily oral pill for severe plaque psoriasis, fundamentally alters patient compliance and convenience.
It directly threatens competitors like AbbVie, who rely on invasive, inconvenient injection therapies. Markets inherently reward that kind of predictable, quiet execution, while absolutely punishing unpredictability and reputational contagion.
Todd Blanche, the nominee for U.S. Attorney General, is currently enduring brutal confirmation hearings. He is facing intense scrutiny over his defense of the Justice Department's handling of the Jeffrey Epstein files.
He is also taking heat for his $160,000 in cryptocurrency holdings while concurrently shutting down crypto enforcement teams, and his defense of FBI Director Kash Patel's use of government jets.
The fear of reputational contagion is causing even the most insulated billionaires to perform aggressive risk management on their personal associations. Warren Buffett permanently pulled his multi-billion-dollar funding commitment from the Gates Foundation, redirecting the capital entirely to his own family trusts.
Buffett explicitly cited Bill Gates' relationship with Jeffrey Epstein, publicly categorizing the association as distasteful.
Capital flees unpredictability, and the withdrawal by its primary benefactor proves that no entity is too large to suffer the consequences of toxic reputational assets.
The overarching pattern today isn't a single event, but a series of boundaries being violently enforced. We're seeing markets price the limit of IBM's downfall, regulators cap utility bonuses, and billionaires sever reputational liabilities.
Which brings us to perhaps the most fascinating new boundary of all. The UK government is moving forward with an overnight social media curfew for 16 and 17-year-olds.
The legislation legally disables infinite scrolling and autoplay videos on platforms like Instagram, TikTok, and YouTube by default.
The regulatory framework here is revolutionary because it approaches the issue not strictly as a public health or parenting crisis, but as a severe market intervention.
By outlawing the specific code that enables infinite scroll, the government is directly dictating the user interface design of multinational technology giants.
It legally defines human attention as a finite, protected economic resource that corporations are no longer permitted to endlessly mine and monetize from miners without inserting deliberate friction.
We started today looking at a market defined by distinct conflicting pressures. Capital is fleeing legacy software, public utilities are collapsing under private debt, and the physical friction of geopolitical conflict is raising the cost of a plane ticket.
The most profound economic shift of all is happening quietly on the screens in our pockets. The realization is that the most valuable, heavily contested resource in the modern economy isn't an AI chip or a barrel of jet fuel.
It is the unblinking, uninterrupted attention of the human mind. Take care, and we will talk again soon.